Take a look at your 401k or your IRA today, and you will likely feel a strange mix of relief and underlying anxiety. On paper, the numbers might look like you are doing everything exactly right. You hit your employer contribution match, you bought the S&P 500 or a target date fund, and the overall balance is sitting near all-time highs. But then you step outside your financial app and enter the real world. You go to the grocery store to feed your family. You pay your annual property taxes. You look at the price of a decent used car or a standard family home, and suddenly, a terrifying realization hits you. Those numbers in your retirement account are lying to you because they are buying significantly less than they did just 5 years ago. Most Americans think this is just a temporary hangover from pandemic-era money printing and supply chain shocks. They think the Federal Reserve will eventually just flip a switch, drop interest rates back to zero, and everything will magically return to the low inflation utopia of 2019. But they are completely blind to a tectonic, irreversible macroeconomic shift happening underneath the global economy at this exact second. Financial elites occasionally call it the Petroyuan. But the mainstream media usually discusses it like it is some boring academic foreign policy issue happening thousands of miles away that doesn't affect the average citizen. It is not. The shift away from the US dollar in global energy markets is actually the single biggest threat to your purchasing power, your savings, and your retirement security since the brutal inflation crisis of the 1970s. Today, we are going to break down the exact mechanism of how global geopolitics is quietly draining your 401k, why the traditional American retirement dream is currently on life support, and most importantly, the exact step-by-step wealth habits you need to adopt right now to protect your family's financial future from a systemic devaluation. To understand why you should be terrified of the Petroyuan, you first have to deeply understand the invisible engine that has powered the American middle class and subsidized our standard of living for the last 50 years, the petrodollar. Back in the 1970s, after the United States completely severed the dollar's tie to physical gold, our currency was in a free fall and inflation was skyrocketing. To save the economy, the US government struck a masterstroke geopolitical deal with Saudi Arabia. We agreed to provide them with the ultimate military protection and weapons, and in exchange, they agreed to something that changed the course of human financial history. They would price all of their massive oil exports exclusively in US dollars. Think about what this actually means on a global scale. If manufacturing powerhouses like Japan, Germany, South Korea, or eventually China wanted to buy the energy required to literally keep their lights on and their factories running, they could not use their own domestic currencies. They first had to acquire US dollars. This created an artificial, bottomless global demand for our currency that had nothing to do with what America was actually producing. Because the entire world needed dollars constantly to buy oil, they also needed a safe, liquid place to store those dollars when they weren't spending them. So what did they do? They took those surplus dollars and bought trillions of dollars in US Treasury bonds. They essentially loaned their money right back to the United States government at incredibly low interest rates. This system was the ultimate cheat code for the American economy. It allowed the US government to run massive multi-trillion-dollar deficits without immediately suffering hyperinflation, because we could just export our inflation to the rest of the world. It kept our mortgage rates artificially low. It funded our massive military and our extensive social programs. When you managed to get a 3% mortgage a few years ago, or when you saw your stock portfolio effortlessly climb year after year, you were unknowingly riding the wave of the petrodollar system. It made the dollar the undisputed king of global finance, and it made the American consumer the most heavily subsidized and powerful economic force on earth. We have lived in a financial bubble of our own making, completely shielded from the harsh realities of global economics. But that golden era is currently being dismantled brick by brick, and it is happening much faster than Wall Street wants to admit. Over the last few years, a coalition of nations led by the BRICS alliance, which stands for Brazil, Russia, India, China, and South Africa, has actively decided they no longer want to play a game where the United States holds all the cards and controls the global financial plumbing. And they are expanding their membership rapidly, bringing in massive energy producers. The true tipping point arrived recently when Saudi Arabia, the very cornerstone of the original 1970s petrodollar deal, signaled it was officially open to accepting other currencies, specifically the Chinese yuan for its oil exports. This is the birth of the Petroyuan. Now, a typical American investor might sit there and say, why does it matter to me if China buys oil from Saudi Arabia using their own money? How does two foreign countries trading in their own currencies affect my retirement account in Ohio or Texas? It matters because it fundamentally breaks the automatic, guaranteed demand for the US dollar. Imagine a massive global stadium where everyone was legally forced to buy food and water using only special tokens issued by the stadium owner. Suddenly, management says you can use any currency you want. What happens to the value of those special tokens? It plummets, because the artificial demand keeping them valuable has vanished. If massive economies no longer need dollars to survive, they will naturally stop buying our debt. And if they stop buying our debt, the US government, which currently owes an incomprehensible $34 trillion and is adding $1 trillion to that pile every 100 days, suddenly has a catastrophic problem. Who is going to fund our deficit? If foreign central banks aren't buying our bonds, the Federal Reserve has to step in and buy them by printing more money, which directly dilutes the value of every single dollar sitting in your bank account. This is exactly where global geopolitics crashes through the front door of your house and actively drains your checking account. When global demand for the dollar drops on the world stage, the value of the dollar drops. And a structurally weaker dollar guarantees one incredibly painful outcome for the American consumer: severe, inescapable imported inflation. The United States is fundamentally a consumer nation. We do not manufacture enough of what we consume. We import trillions of dollars worth of goods every single year. We import the microchips in your smartphone, the vital components in your Ford truck, the textiles in your clothing, and even massive amounts of agricultural fertilizer required to grow our food. If the dollar is weaker on the global exchange, it takes more of your hard-earned dollars to buy the exact same goods from overseas. This means the inflation we have suffered through recently isn't going to just magically disappear. It is going to become structurally baked into our economy. It becomes a permanent, silent tax on your life. And what does a permanent, silent tax do to your 401k? If inflation stays stubbornly high because of a weakening dollar, the Federal Reserve is trapped in a nightmare scenario. They are forced to keep interest rates higher for much longer than Wall Street wants, just to keep prices from completely spiraling out of control. But high interest rates are absolute poison for corporate expansion. When American companies face skyrocketing borrowing costs and their profit margins get severely squeezed by persistent inflation, they stop hiring, they stop innovating, they lay people off. And most importantly for your portfolio, their stock prices stagnate or completely drop. This brings us to the most dangerous lie currently being sold in American personal finance: the traditional 60-40 portfolio. Financial advisors have spent decades telling you to put 60% of your money in stocks, 40% in bonds, close your eyes and wake up rich at 65. But that advice was explicitly built for a petrodollar world where inflation was artificially suppressed and interest rates were constantly falling. In a Petroyuan world, traditional, plain vanilla retirement accounts that are heavy in domestic index funds could face what economists call a lost decade of real returns. Let me do the horrifying math for you. Your portfolio might go up by 4 or 5% a year on paper, and your advisor might even call to congratulate you on the gains. But if real-world inflation is running at 6 or 7% because the dollar is losing its global dominance, your actual purchasing power is negative. You are secretly getting poorer every single day, while actually paying capital gains taxes on the absolute illusion of a profit. The system that guaranteed easy, set-it-and-forget-it stock market returns for the last 40 years is actively changing the rules of the game, and millions of Americans are still playing by the old rulebook, completely unaware that the board has been flipped. You cannot control what the Federal Reserve does, and you certainly cannot control what foreign oil producers or massive geopolitical alliances do. But you absolutely 100% control how your money is positioned. In this new macroeconomic reality, you have to dramatically upgrade your wealth habits to survive the transition. The first mandatory step is true asset diversification. I am not just talking about having a mix of tech stocks and healthcare stocks in your Vanguard account. That is fake diversification. You need to diversify outside of the traditional US fiat system entirely. In a world where paper currency is being aggressively debased to manage an unpayable $34 trillion national debt, you need intense exposure to hard assets. This is exactly why you see foreign central banks and massive institutional money quietly accumulating record amounts of gold, silver, prime real estate, and Bitcoin. These are assets that absolutely cannot be printed out of thin air by a desperate politician or a central banker. They require actual energy and work to produce, and they have historically acted as the ultimate financial life raft when fiat currencies inevitably lose their global dominance. You do not need to put your entire life savings into them, but having a meaningful structural allocation to hard assets is no longer a fringe doomsday idea. It is a mathematical necessity and a mandatory insurance policy for your wealth. Secondly, you must shift your mindset from accumulating cash to generating aggressive cash flow. When inflation runs hot and the currency is fundamentally broken, cash is trash. Sitting on a massive high-yield savings account might feel safe, but it is guaranteed financial suicide over a 10-year timeline. You need to build or buy streams of income that can scale directly with inflation. If you own a cash-flowing business, rental real estate, or a high-margin side hustle, you have the ultimate superpower, the ability to raise your prices as your underlying costs go up. If you are strictly a W-2 employee living on a fixed salary, you are completely at the mercy of your employer's annual 3% raise, which we already mathematically know isn't keeping up with the real cost of living. Finally, the absolute best hedge against a shifting global economy is aggressively upgrading your personal balance sheet through your human capital, acquiring high-income, high-demand skills. Whether that is in complex B2B sales, digital marketing, advanced coding, or specialized financial consulting makes you completely irreplaceable. Geopolitics can devalue a paper currency overnight, but it absolutely cannot devalue a rare, highly profitable, and adaptable skill set. The transition from the petrodollar to a chaotic, multi-currency world is not going to happen overnight. It is a slow, grinding process, but the massive wheels of history are already turning. The investors who get completely wiped out are always the ones who stubbornly assume the next 10 years will look exactly like the last 10 years. But the investors who build true generational wealth are the ones who read the shifting macroeconomic tides, put away their biases, and actively adjust their sails before the massive storm hits. Your 401k and your retirement aren't necessarily doomed, but they do require your immediate active attention. Stop relying entirely on a system that is actively collapsing under its own weight. Start building your position in hard assets. Start focusing on aggressive, scalable cash flow, and start taking absolute control of your financial education today, because the world is shifting rapidly and you need to make sure your portfolio shifts with it.